In July 1995, a bond trader at a Japanese bank's New York office sat down and wrote a 30-page letter to his president confessing to 11 years of hidden trading losses. The letter itself was not the catastrophe. The catastrophe was what management chose to do next. They waited roughly 2 months before telling U.S. regulators, and that decision transformed a massive internal fraud into one of the most severe regulatory actions ever taken against a foreign bank in American history. Founded in Osaka in 1918, Daiwa Bank grew across the 20th century into one of Japan's major regional commercial banks. By the 1970s, it had opened a New York branch to serve the growing volume of Japanese corporations doing business in the United States. The branch held U.S. Treasury bonds in custody for institutional clients, executed bond trades for the bank's own account, and filed routine regulatory reports with U.S. authorities. On paper and in practice, it looked entirely ordinary. Toshihide Iguchi joined Daiwa's New York branch in the mid-1970s and worked his way from clerical duties into U.S. Treasury bond trading. At some point in the early 1980s, he was given a second set of responsibilities alongside his trading role. He also oversaw reconciliation of the custody accounts that held client bonds. Combining those two functions in one person violated what banking regulators and internal auditors call separation of duties. That principle exists for a precise mechanical reason. If the same employee executes a trade, records it, and reconciles the custodial position, he is the only person who could catch his own error or his own fraud. There is no independent check. Watch the full breakdown on Wealthwright.